All right, today we're going to crack open a kind of hidden playbook for the financial markets. It's all about a framework called smart money concepts. And the big idea here? It's that the market's moves, well, they aren't random, not at all. In fact, a lot of the time, they're super intentional.
You know that feeling, right? It's something pretty much every trader has gone through. You place a trade, you set your stop loss like you're supposed to, and then, bam, the price comes down, hits it perfectly, and then immediately reverses and skyrockets in the direction you predicted. Ugh, it feels personal, doesn't it? It almost feels rigged. But what if it's not personal? What if it's just part of the game?
And that right there is the core idea. The whole theory behind smart money concepts is that these wild swings, they're not just the chaotic result of millions of people clicking buttons. Nope. The idea is that they are often deliberate, engineered moves. They're designed for a very specific purpose.
So, to get what that purpose is, we've got to first figure out who the players are and what the rules of this hidden game actually are.
Okay, so on one side of the board, you've got us, right? The retail traders, the public. And on the other side, you've got the so-called smart money. We're talking about the big banks, the huge financial institutions. These guys are moving massive amounts of money, and believe me, their goals are totally different from ours.
Yeah, and this quote really hits the nail on the head. It points out a super critical fact. The market is a zero-sum game. What does that mean? Well, for every winner, there has to be a loser. It's that simple. If a giant bank wants to buy, say, $1 billion worth of something, somebody, somewhere, has to be selling $1 billion worth.
So that's the big question, isn't it? How on earth do they find all those sellers when they want to buy, or all those buyers when they want to sell? Well, the answer comes down to one absolutely crucial concept.
And that concept is liquidity. Now, it sounds kind of technical and complex, but just think of it like this. Liquidity is the fuel that makes the market engine run. And for the smart money, the biggest, richest gas station around is that huge, predictable pool of stop-loss orders that retail traders, people like us, put in every single day.
And this liquidity, it basically comes in two main flavors. You've got buy stops liquidity, or BSL for short. That's just the big cluster of stop losses that people place right above an old high. Then you've got sell stops liquidity, or SSL. And you guessed it, that's the opposite. All the stops sitting just below an old low.
Okay, and this right here brings us to their main tactic, the stop hunt. Remember that frustrating spike we talked about at the very beginning? This is it. It's an engineered move designed for one reason and one reason only: to blast into those pools of BSL or SSL, trigger all those stop losses, and basically suck up all that liquidity for themselves. Now, I know what you might be thinking. This sounds a little bit like a conspiracy theory, right? But the thing is, these patterns are visible right there on the charts if you just know what you're looking for. And it all starts with understanding something called market structure.
Okay, so the single most important signal you need to watch for is the break-in market structure, or BMS. Just think of it like the first domino to fall. It's your big clue that the trend might be about to completely change direction. And all it is really is when the price breaks and closes past the previous high or a previous low. So for example, let's picture a simple uptrend. The price goes up, makes a high, pulls back a bit to a higher low, and then pushes up again and breaks that previous high. That is your bullish break-in market structure. It confirms the uptrend is still on. And of course, the exact opposite is true for a downtrend.
So here's the really crucial point to get. Tracking market structure, it's not just about drawing fancy lines on a chart. It's about creating a map, a treasure map really, that shows you where the real target, that liquidity we talked about, is probably hiding. So where do these big pools of liquidity form? Well, they tend to gather in really predictable places. The high and low of the previous day, huge magnets for liquidity. The high and low of the previous week, even bigger. And you know those perfect, clean, equal highs or lows that traditional charting calls strong support or strong resistance? Yeah, in this playbook, that's just seen as a giant, tempting pool of stop losses just sitting there, waiting to be taken. And this is where you have to flip your thinking completely on its head. When you see the price shoot up and take out all that buy-side liquidity, the smart money isn't buying that breakout with everyone else. No way. They're selling into that frenzy of triggered stops. And when the price crashes down and grabs all the sell-side liquidity, they are busy buying from everyone who is panic selling. Okay, let's do a quick recap. We have the players, smart money versus retail. We have their motive, liquidity. And we have their main signal, the break-in structure. So now, let's put it all together and see what these moves actually look like in the wild.
All right, one of the classic patterns you'll see is called the AMD cycle. That stands for accumulation, manipulation, and distribution, and it often lines up with the trading day. So first, you get accumulation, where positions are being built up, usually during the quiet Asian session. Then comes the manipulation. This is that sharp, fake-out move, often right at the London Open, and its whole job is to hunt liquidity. And only after that does the real move, the distribution phase, actually begin.
And all of that, it brings us to what you could call the signature play of this whole framework. This is the one that combines everything we've just talked about into one powerful, high-probability pattern. It's called the stop hunt, plus the break-in structure, plus the return to order block, or for short, SH plus BMS plus RTO. Let's just break that down real quick. Step 1, you see the stop hunt. That's the price rating a pool of liquidity. Step 2, you get your confirmation. That's the break-in market structure, showing a shift in the opposite direction. And then step 3, the final piece, you wait for the price to come back to return to the order block.
So you're probably asking, what the heck is an order block? It's actually super simple. It's just the very last up candle before a big down move, or the last down candle before a big up move that breaks structure. The theory is that specific candle is where the huge institutional orders were originally placed. It's like the launch pad for the entire move.
And look at this, you can see the whole sequence playing out. First, you get that spike up, that's your stop hunt grabbing liquidity. That's followed by a big sharp move down that creates the break-in market structure. And then finally, you see the price pull back just one last time, right back to that order block, and then the real move continues. That's the whole playbook right there in one single pattern.
So let me ask you this. The next time you're looking at a chart and you see one of those sharp spikes that just seems to come out of nowhere, maybe you'll ask yourself a different question. Was that really a random move? Or was it engineered to capture liquidity? Honestly, knowing this playbook, it might just change the way you look at the markets forever.